Complete a purchase at a retail register, and the execution is nearly invisible. Payment data, identity verification, and ledger reconciliation all trigger and resolve in a fraction of a second. Commercial equipment finance operates in a different reality. Securing capital for physical assets frequently involves manual data entry, PDF email chains, and redundant credit checks that can drag an approval process out for days. The contrast between those two experiences is forcing a structural correction. The industry refers to this pressure as the consumerization of business-to-business lending. Business owners are also retail consumers. They manage their personal finances through highly integrated 24/7 mobile applications, and they now expect that same level of frictionless access from their commercial lenders. This Tenemo survey compares digital sales capabilities across financial sectors. While business banking lags behind consumer retail, its upward trajectory reveals a rapid acceleration in digital commercial offerings. Traditional institutions are prioritizing digital infrastructure investments to keep pace. Failing to meet these expectations leads directly to customer attrition. Borrowers will migrate to tech-forward competitors who can deliver capital without administrative delays. Delivering a consumer-grade experience requires modern software architecture, which exposes a structural vulnerability inside established financial institutions. Many traditional equipment finance firms operate on monolithic legacy core systems. These foundational platforms often rely on outdated programming languages like COBOL. COBOL, or Common Business-Oriented Language, is a coding language developed in 1959 that remains the backbone of many established banking ledgers, despite its rigidity. These closed architectures trap customer data inside isolated silos. Extracting information from the credit department and moving it to the servicing department requires navigating rigid internal bureaucracies rather than automated data flows. To bridge the gaps between these disconnected systems, staff rely on analog workarounds. Employees physically print documents, scan them as PDFs, and manually rekey the exact same data into different operational software. Going digital in commercial finance means entirely eliminating human touch wherever it is unnecessary for processing or decision-making. Achieving a touchless workflow requires abandoning closed legacy cores and transitioning to a modular, API-driven software architecture. This allows different systems to communicate and share data automatically. Developing a sleek web portal achieves nothing if the data hits an analog bottleneck the moment it reaches the back office. The inability of legacy lenders to modernize their backends has created an opening for a distinct competitive threat: non-bank technology companies. Tech firms like Square, Amazon, and PayPal do not start as lenders. They embed themselves into a business as daily operational software, processing merchant payments and tracking inventory. This gives them uninterrupted visibility into a company's real-time cash flow. They feed that proprietary cash flow data into automated underwriting models. This allows them to proactively issue pre-approved credit offers directly through the software interface, often before the business even initiates a search for a loan. This diagram shows non-bank entrants surrounding the business relationship. By controlling daily software, tech companies funnel users directly into proprietary banking products. The traditional financial institution remains isolated on the perimeter. The tech platform intercepts the borrower, securing the transaction before an application is filed. These non-bank entities are scaling up. They are moving past short-term, small-ticket loans and targeting the mid-ticket equipment finance sector. Many of these platforms operate as digital loan kiosks. If they do not want to hold the debt themselves, they use their data advantage to instantly match the borrower with a network of partner lenders. Whoever controls the daily digital interface ultimately dictates the commercial lending relationship. Fintechs construct this seamless user experience using application programming interfaces, or APIs. An API is a set of standardized rules that allows distinct software systems to request and exchange data securely and instantly. The accounting software provider Xero demonstrates how effectively an API framework can build a comprehensive business-to-business ecosystem. This diagram shows Xero's API integrated architecture. The workflow begins at the front office for client interactions. Xero uses a foundational API layer to plug directly into third-party services like Stripe and Square. This external data flows automatically into Xero's back office for final servicing and analytics. This modular structure allows the company to rapidly integrate the best available third-party financial products into their interface without absorbing the costs of developing that software from scratch. An API framework provides agility. When a better payment processor enters the market, the platform can disconnect the old node and plug in the new one. A legacy core system requires years of custom coding to achieve a fraction of that adaptability. Relying on interconnected, API-driven software is the technical baseline required to compete in modern commercial finance. Traditional lenders can adopt this exact architecture to solve localized operational failures. Volvo Financial Services, or VFS, applied this model to eliminate a specific customer friction point. International transport fleets require rapid vehicle maintenance, but cross-border repair authorizations generate immense operational drag. When a driver requires emergency service in a foreign country, establishing payment terms between the local workshop and the home fleet manager relied on phone calls, manual credit checks, and language barriers, leaving the vehicle stranded. VFS executed a targeted partnership with Payer, a business-to-business technology firm, to entirely digitalize this repair payment workflow. The workflow initiates when the foreign repair center creates a service order. An API instantly routes this data into the Payer platform, which sends a mobile notification to the home fleet manager. The manager executes an instant approval, triggering real-time payment capture at the workshop. A targeted API integration stripped the manual friction out of an international repair authorization and secured the transaction in real time. Deploying a mobile approval app solves the front-end customer friction, but it only completes half the necessary architecture for Volvo Financial Services. The critical result occurs on the back end. The API routes the captured payment data directly into the company's SAP ERP system. ERP, or Enterprise Resource Planning, is a suite of integrated software used by organizations to manage day-to-day business activities like accounting and procurement. SAP is a major global provider of these systems. This real-time reconciliation ensures the corporate ledger is accurate the moment the repair clears. It removes the need for back-office manual data entry, cuts down the invoicing cycle, and limits credit risk. This logic defines a modernized equipment finance tech stack. A digital lender replaces isolated silos with communicating software. They route prospect data through Salesforce, execute leasing math with SuperTrump, and capture contracts with Payer, functioning as a unified system. True digitization is not achieved by purchasing a single piece of software. It is a continuous, dynamic architectural strategy. The objective remains absolute: identify manual processes and implement technology to eliminate human intervention wherever it is unnecessary. Lenders must map their specific customer workflows, locate the points where analog friction causes delays, and evaluate their current internal software limitations. By deploying targeted API integrations to systematically remove those bottlenecks, traditional financial institutions can match the instant, transparent service their borrowers experience every day.